Morning, everyone. Welcome to the monthly lifestyle webinars. Today's topic is on things to consider when buying a property. My name's Harry Tong, and I am the mortgage consultant in Lifestyle Financial Services. Today's webinar is to provide some guidance and information for those that are looking or are planning to purchase a property. Today, I want to talk about some of the costs involved when buying a property so that you can budget for them. Talk about some options for a deposit on a property, things to consider when looking at home loans, talk about rent vesting, and traps to look out for when buying a property and getting a loan. Those that are planning to purchase a property, here are some of the things to consider when before you put down that deposit. Work out how much you have to put down for a deposit and what your purchasing costs will be. It's preferable to have at least 20% deposit, as you will save on lender's mortgage insurance. But if you don't have that, I strongly recommend that you have at least 10% of the deposit. Anything less can make it very costly to purchase, and you'll likely miss out on the more favorable rates. Some of the costs you'll likely incur when purchasing include conveyancing fees, building inspection and strata reports. Whilst these are not necessary, it is advisable to get these reports. They can cost about $400 for a building report and $300 for a strata report, depending on how involved it is. Your solicitor and conveyancer can order these for you or recommend someone. Government fees such as stamp duty, property transfer fee, mortgage registration. These can be around 4 to 6% of the purchase price and vary between states. Bank fees such as loan establishment fee, settlement fee, lender's mortgage insurance, if applicable. If you're buying something that's a bit run down, possible repairs or renovation costs. If you're buying a unit, there's strata fees to consider and perhaps special levies. All apartment buildings will charge a quarterly fee to the owners. This is where the strata report can come in handy. It might show you any plans to renovate the building or fix problems. And if you look at the balance in the accounts of the strata plan, and if there's not much money there, then there's a good chance that a special levy might have to be raised down the track with all the owners to fund the renovation or repairs. And then there's building insurance for those buying a house. So before we want to go any further, I just want to do a quick poll. Do we have any first home buyers online? So it seems like we've got a lot of first home buyers or people looking for their first home listening. So this graph shows you the proportion of first home buyers in the market at the moment. In the last 12 months, the number of first home buyers has increased, especially in New South Wales and Victoria. However, the proportion is now nowhere near the peak of 2009, but has reversed the trend of the past few years. The increase has largely been assisted by new first home buyer grants and slowing prices. For first home buyers, these are some of the assistance announced last year. The federal government will allow first home buyers to salary sacrifice into their super, where there is more favourable tax treatments on the contributions and earnings. There are limitations on the amount though. I think it's $15,000 per annum and $30,000 over the term, but it could help you save for that deposit a little bit quicker. On the state government level, New South Wales and Victoria have waived stamp duty for first home buyers on existing and new homes up to a certain amount. In New South Wales, it's waived for purchases up to $650,000, with stamp duty discounts up between $650,000 to $800,000. In Victoria, stamp duty is waived for purchases up to $600,000 and stamp duty discounts up to $750,000. These can save first home buyers up to $30,000 in stamp duty. And for those buying new properties or building a new property, many states offer first home owners grant, which is a few $1,000s depending on the state. For those that don't have a 20% deposit, the lenders will ask you to pay lender's mortgage insurance, or LMI for short. This is insurance to protect the lender, not you, but the lender, in case you don't recover enough to clear your loan in the event of default, and they have to sell your property and don't recover the full amount. LMI can be quite costly and can cost around 2 to 4% of the purchase price, depending on the loan amount relatively to the value of the property, what the lenders call LVR, loan to value ratio. The higher the LVR, the higher the premium. So here's an example on a $700,000 purchase. If you borrow 85%, LMI is approximately $9,800. But if you go up to 95%, LMI is approximately $30,000. That's more than 3 times. This premium can also vary between lender to lender. For those saving for a deposit, this graph gives you an idea of how long it will take you to save for that deposit for a property in the capital cities around Australia. It's about 11 years in Sydney and 10 in Melbourne. It's an average, so some might get there faster than others. So what are the options for a deposit? You can set a budget and save very hard. Aim for 20% deposit, but if you don't have that and still want to get into the market, I think you should have at least 10% before even thinking about it. You'll have to pay LMI, but many lenders will let you capitalize this onto the loan, that is, borrow extra to cover the LMI. For the lucky ones, your parents can gift you some of the money. The lenders will ask your parents to sign a declaration to say how much they are giving you, and that you don't have to pay them back. That way, it's not considered a loan to you from the parents, and the lenders won't have to assess this as a loan to you that needs to be paid back. The other option for those parents that have a home they own outright or have sufficient equity in them is to provide their home as additional security for your loan. These loans, often called a family pledge loan, are becoming more common, especially in places like Sydney and Melbourne. So how does a family pledge work? You have less than 20% deposit for the purchase. Mum and Dad put their home or investment property to make up the shortfall, allowing you to borrow the shortfall rather than come up with the cash. So for example, if you're buying a property for $500,000 and you've only got $50,000, to come up with the 20%, you need another $50,000 in cash. But if your parents put up the security, they can cover that $50,000 shortfall, so you can borrow the $450,000. Some of the banks will do the whole lot as one loan with a limited guarantee from the parents. Some will break up their portion as a separate loan. Once there is sufficient equity in your property to secure all the debt within 80%, you can ask the bank to remove the guarantee from the parents. This can happen with you paying down a sufficient amount in your loan, or your property increases in value, or both. Parents should seek legal and financial advice to make sure that they understand the risks involved, though. So if you have money saved up, the next thing you should do is speak to a lender or mortgage broker to see what your borrowing capacity is. Together, work out the amount of loan that you will likely be able to get based on your current income, living expenses, and commitments. Note that whilst the lender might be willing to lend you a certain amount, you should road test this to see if you can actually afford it, as it may involve adjusting your lifestyle to meet this new commitment. Once you're comfortable with this, then you should speak to a lender or broker to get a pre-approval on a loan for a loan amount, so you know that you will be able to get finance when you find a property you want. You should then work out the type of home loan you want. This will depend on your circumstances and your interest rate expectations. Things to consider when taking out a home loan are interest only or principal and interest. Interest only means you are only paying the interest costs every month and not paying down the balance. There are cash flow advantages by doing so, but may mean that you end up paying more interest over the life of the loan. It's an option for property investors who can claim the interest costs as a tax deduction and use the extra cash flow towards another purchase or pay down non-deductible debt. Rates are also generally higher for interest-only loans. Fixed or variable. For fixed rate loans, the rate doesn't change during the fixed period, and hence you know what the repayments will be for that period. You are protected from rate rises during that period. The disadvantage is that you will likely incur some penalties if you make too much extra repayments into the loan or make changes to it. An option is splitting the loans, where you have some of it fixed and some of it variable. That way you have some of the advantages of fixed rates and variable rates. Many loans come with an offset account. The offset account is like your everyday personal account, but the balance in the offset account offsets the balance in the loan before interest is calculated. This account can save you interest over the life of the loan and can help you pay the loan off faster. Loan packaging versus basic home loans. Many lenders will offer a loan package where you pay one annual fee, which will cover the costs of the loan or loans, an offset account, and a credit card. This will offer discounts on they will offer discounts on their standard variable rate. Most lenders will also have their basic home loan where there is a competitive rate, is usually fee-free or a small monthly fee, but does not come with your bells and whistles like loan splitting, offset accounts, or credit cards. Those that take out large loans will usually get a better rate on a package. The basic loans are good for those taking out a small loan or don't need the other products with it. So what if you want to get into the property market but can't afford to buy where you want to live? I thought I'd talk a bit about rent vesting. It's a term that's popped up in recent years and is now becoming more common in the expensive property market. Rent vesting is a term used where someone who wants to get into the property market but cannot afford to buy where they want to live. So instead, they rent a home where they want to live but buy or invest in a property where they can afford. For example, say you wanted to buy a house in Sydney's inner west, but the sale prices in the area mean that these homes are out of your reach. The rent vesting solution to the problem would be to rent the ideal house where you want to live and then buy a property in a suburb where prices are more affordable. The property you buy can then be rented out to help cover your own rental payments or later sold for a capital gain. This strategy lets you have the lifestyle you want now while at the same time build a property portfolio for the future. What are the pros and cons of rent vesting? Well, for the pros, rent vesting allows you to break into the property market sooner with a smaller deposit as opposed to waiting several years until you're able to afford your dream home. It lets you live the lifestyle you want. You rent in the area you want to live in but can't afford to buy. Rent vesting allows you to start building your investment portfolio, which can be used to generate wealth for you and your family in the future. Owning an investment property allows you to save to buy your dream home later on. Rent vesting provides flexibility. When you're renting, you can easily upgrade or downgrade to a different home if your circumstances change. For example, if you lose your job or start a family. It also gives you the freedom to move around or test the suburbs you want to live. There's tax benefits. You can claim interest payments on your investment property loan as a tax deduction. Also, where you want to live and the best place to buy an investment property often won't be the same. So rent vesting allows you to be invested in an area with the best returns, but not necessarily where you want to live. So the cons, many people have this view that rent is dead money. By rent vesting, you're still paying rent. You don't own your home. This can be especially difficult if you form an emotional connection to a house, but then the landlord wants you to move out. As you don't own the place you are renting, you can't renovate or make improvements to suit yourself. Buying an investment property doesn't qualify for first home owner's grant or any government assistance either, so take that into consideration. And if the investment property becomes vacant, you still have to make the loan repayments and also pay rent on your current home, which can hurt your cash flow. Some tips to be aware of if you're buying a property. Be careful if you're buying a unit in a high-rise. A high-rise is usually defined as anything over 5 stories or greater than 40 apartments. Most lenders have reduced their maximum lending from 90% to 80% or even 70% on high rises or units in certain postcodes. Best to check with the lender before putting down a deposit. Be extra careful when buying off the plan and make sure your solicitor checks the contract. Lending conditions may change by the time the property is completed and ready to settle. So some people that have put deposits down on an off-the-plan purchase a couple of years ago are now struggling to get finance to complete the purchase because changes to lending policies. If you're borrowing more than 80% on the property value, you'll have to pay mortgage insurance. This can be about 2 to 4% of the purchase price as the lending ratio gets higher. So make sure you factor this in. Look, it's exciting to own your own home, and we're obsessed with property ownership in this country. However, make sure you can afford the commitment and don't overextend yourself. Interest rates are at historic lows and will likely go higher in the future. Make sure you can afford to meet the repayments when rates do go up, and take the opportunity now to build a buffer into your home loan. If you take out a fixed rate or a honeymoon rate, just be careful that you can afford to make the repayments if rates are higher when they come off these special rates. This also applies to those taking out interest-only loans. When the interest-only period matures, the loan will revert to principal and interest over the remaining term of the loan, and repayments can be significantly higher. If this becomes a problem for you, you should talk to the lender or a broker early to organise a loan with a better rate, or perhaps restructuring the loan. In recent months, there's been a big focus on living expenses, as lenders have previously underestimated this. Lenders are now checking accounts and credit card statements to verify the living expense you declare is accurate. This can really affect your borrowing capacity, as the higher your living expense is, the less there is available to service your loan commitments. Those that have credit cards, just note that lenders assess cards at their limits and not on their balances. So even if you have a card that you pay off every month, the lender will still include the limit in its calculations. They will apply 36% to the limit. So this can really affect your borrowing capacity, especially if you have a few cards. So that's the end of my presentation. I'll leave you with my contact details. Feel free to call me or email me if you have any questions or need assistance.